Hey, welcome back. Imagine being able to see exactly what the wealthiest, most successful crypto investors in the world are buying and selling in real time, completely for free. That is not a fantasy. That is exactly what whale wallet tracking gives you. A whale is a wallet holding a very large amount of cryptocurrency, large enough that its transactions can actually move the market. And here is the thing most beginners do not realize. Every single move these whales make is permanently recorded on a public blockchain. There is no hiding it, there is no privacy. Anyone with the right tools can watch these wallets in real time. While most retail traders are reacting to price charts after the move has already happened, whale watchers are seeing the early footprints of accumulation and distribution before the price fully reflects it. This does not mean copying every whale trade blindly. Whales make mistakes too. But understanding what large, sophisticated capital is doing gives you genuinely valuable context that most retail investors never bother to look for. Today, I'm going to show you exactly how to track whale wallets, what tools to use, what signals actually matter, and how to use this information to make smarter decisions without falling into the common traps that whale watching beginners make. Let us get into it. What is a whale and why does their activity matter? Let us start with a clear definition. A whale is a wallet address that holds an amount of cryptocurrency large enough to significantly influence the market if it buys or sells. There is no single universal threshold, but for Bitcoin, this typically means wallets holding 1,000 Bitcoin or more. For Ethereum, it typically means tens of thousands of Ether or more. For smaller altcoins, the threshold scales down significantly since smaller projects have far less liquidity. Whales include several different types of holders. Early investors and founders who accumulated large positions before a project became well known. Institutional investors, including hedge funds and corporate treasuries. Centralized exchanges that hold large amounts of customer funds in their own wallets, and in some cases, the original developers or foundations behind a specific project. Here is why tracking whale activity matters so much. When a wallet holding a massive amount of crypto makes a move, that single transaction can represent more buying or selling pressure than thousands of retail trades combined. A whale moving $50 million worth of Bitcoin onto an exchange is potential selling pressure equivalent to what it might take thousands of retail traders to generate collectively. Whale behavior also tends to be more informed than average retail behavior, though certainly not always correct. Whales often have access to better research, longer time horizons, and in some cases, information advantages that retail traders simply do not have. While this does not make them infallible, their aggregate behavior patterns have historically provided meaningful signals about market direction. The key insight is this: you are not trying to predict exactly what an individual whale will do next. You are trying to identify patterns across multiple whale wallets that suggest broader accumulation or distribution trends happening beneath the surface of the price chart. The best free tools for whale tracking. Now let us get into the practical tools you can start using today, most of which are completely free or have substantial free tiers. Tool 1. Whale Alert. Whale Alert is the most well-known whale tracking service and operates primarily through its social media account, posting real-time alerts whenever a transaction above a certain threshold occurs on major blockchains. You can follow Whale Alert directly to see a continuous stream of large transactions across Bitcoin, Ethereum, and many other networks. This gives you a general pulse of large money movement happening across the entire crypto market in real time. Tool 2. Etherscan and Blockchain Explorers. Every major blockchain has a corresponding explorer website. Etherscan for Ethereum, a Bitcoin block explorer for Bitcoin, Solscan for Solana, and so on. These explorers allow you to look up any specific wallet address and see its complete transaction history, current holdings, and activity patterns. If you identify a specific whale wallet address you want to monitor, you can bookmark it on the relevant explorer and check it regularly, or in some cases, set up notification alerts for new activity. Tool 3. Nansen. Nansen is a more advanced on-chain analytics platform that labels millions of wallet addresses, identifying which ones belong to known funds, exchanges, founders, and other significant entities. This labeling is incredibly valuable because it transforms an anonymous string of characters into actionable information, telling you specifically whose wallet you are watching. Nansen has paid tiers for advanced features but offers meaningful free access as well. Tool 4. Arkham Intelligence. Arkham provides similar wallet labeling and entity tracking capabilities with a strong visual interface for tracking fund flows between wallets and exchanges. It is particularly useful for visualizing how money moves between different known entities over time. Tool 5. Glassnode and CryptoQuant. These platforms aggregate whale wallet data into broader metrics, showing you trends in whale accumulation or distribution across the entire market, rather than requiring you to track individual wallets manually. Starting with Whale Alert for general awareness and a Blockchain Explorer for specific wallet investigation gives you a solid free foundation before considering any paid tools. What signals actually matter? Having access to whale data is only useful if you know which signals are actually meaningful and which ones are just noise. Signal 1. Whale wallets moving coins to exchanges. When a whale transfers a large amount of crypto from a private wallet to a known exchange wallet, this is one of the most reliable early warning signals of potential selling. Exchanges are where trading happens, so depositing coins there is usually a precursor to a sale, though not always immediately. The signal becomes more significant when you see multiple different whale wallets making similar moves within a short time frame, suggesting a broader pattern rather than one individual's isolated decision. Signal 2. Whale wallets moving coins off exchanges. The opposite pattern, where large amounts move from exchange wallets to private cold storage wallets, suggests accumulation and an intention to hold long term. This is generally viewed as a bullish signal, particularly when it happens consistently over an extended period rather than as a single isolated transaction. Signal 3. Dormant wallets becoming active. Wallets that have held coins without any movement for years suddenly becoming active deserve special attention. This can indicate that very early, often deeply profitable holders are making a decision about their position, whether that is taking some profit after years of holding or repositioning their assets. Dormant whale activity, especially involving wallets that have held since very early in a project's history, often gets significant attention from the broader on-chain analysis community. Signal 4. New whale wallets accumulating. When you see brand new wallets or previously smaller wallets rapidly accumulating large positions over a relatively short period, this can indicate new, sophisticated capital entering the market. This is particularly meaningful when it happens during periods of low prices and negative sentiment, suggesting informed buyers are taking advantage of conditions that retail investors are avoiding. Signal 5. Coordinated movement patterns. The most powerful signals often come not from a single whale transaction, but from patterns across multiple whales moving in the same direction around the same time. One whale moving coins to an exchange could mean almost anything. 20 different whale wallets, all moving significant amounts to exchanges within the same week, is a much stronger and more meaningful signal. Common mistakes whale watchers make. Before you start applying whale tracking to your own decisions, let me walk you through the mistakes that cause beginners to misread this data. Mistake 1. Assuming every exchange deposit means selling. Not every transfer to an exchange results in an immediate sale. Whales also move coins to exchanges for other reasons, including using them as collateral for loans, moving funds between their own accounts on different exchanges, or preparing for completely unrelated transactions. A single large deposit should be noted but not immediately treated as confirmed selling pressure. Mistake 2. Confusing exchange wallets with individual whale wallets. Many of the largest wallets visible on blockchain explorers actually belong to exchanges themselves, holding customer funds collectively rather than representing a single whale's personal holdings. Mistaking an exchange's customer custody wallet for an individual whale accumulating a massive personal position is a very common beginner error. This is exactly why wallet labeling tools like Nansen and Arkham are so valuable, since they help you distinguish between these different wallet types. Mistake 3. Overreacting to single transactions. A single whale transaction, even a very large one, is just one data point. Markets are influenced by millions of participants. Treating any single transaction as a definitive signal that demands an immediate trading decision is a recipe for being whipsawed by noise rather than identifying genuine patterns. Mistake 4. Ignoring the broader market context. Whale activity should always be interpreted within the context of overall market conditions, including price trend, on-chain metrics we have covered in previous videos, and macro environment. A whale accumulating during a clear uptrend with positive broader on-chain signals tells a very different story than the same whale activity occurring during a clear downtrend with deteriorating fundamentals. Mistake 5. Trying to front run or copy individual whale trades exactly. Whales often have different time horizons, risk tolerances, and capital constraints than individual retail investors. Blindly copying a specific whale's exact trade without understanding their broader strategy or reasoning is fundamentally different from using whale behavior as one input among many in your own independent decision-making process. Let me bring your complete whale tracking framework together. A whale is a wallet large enough to meaningfully influence the market with its transactions. Their movements are permanently visible on public blockchains, giving you genuine insight into large-scale capital behavior that simply did not exist in traditional financial markets. Use Whale Alert for general real-time awareness of large transactions across the market. Use blockchain explorers to investigate and monitor specific wallets you have identified as significant. Use Nansen and Arkham for advanced wallet labeling that tells you who you are actually watching. Use Glassnode and CryptoQuant for aggregated whale trend data across the broader market. Watch for coins moving to exchanges as a potential early selling signal. Watch for coins moving off exchanges as a potential accumulation signal. Pay special attention to dormant wallets becoming active and new wallets rapidly accumulating. And remember that coordinated patterns across multiple whales are far more meaningful than any single isolated transaction. Avoid the common mistakes. Do not assume every exchange deposit means selling. Do not confuse exchange custody wallets with individual whale positions. Do not overreact to single transactions. Always interpret whale activity within the broader market context. And never blindly copy individual whale trades without understanding your own strategy. Here is the perspective I want to leave you with. Whale tracking is not a magic system that tells you exactly what to do next. It is one powerful layer of evidence that, combined with price analysis, broader on-chain metrics, and your own research, helps you build a more complete and informed picture of what is actually happening in the market beneath the surface of the price chart. The wealthiest and most sophisticated participants in this market cannot hide their footprints. They are recorded permanently and visible to anyone willing to look. Most retail investors never bother to look. Now you know exactly how. If this video gave you a genuine framework for tracking whale activity, please hit the like button and subscribe. This is the kind of analytical edge that very few retail investors take the time to develop. Drop a comment below and tell me which whale tracking tool you are going to try first. I read every comment and I want to know where you are starting. I will see you in the next one.